Susan's not hiding, huh? Hi, Susan. I know she doesn't want to be on there. You're muted, just not.
Welcome, everyone, to Name Confidential Live.
There we go. Hey, everyone. Welcome to Name Confidential Season 2, Episode 26. I'm this week's host, Ryan Redfern. Today we have Jay Peroni, CFP from Faith Investor Services. We're going to dive into some faith-based investing. His firm runs ETFs and we do some financial planning. So we're going to dive into all of those things today. But first, I'm going to stop sharing that and we're going to flip to the name sentiment indicator, which of course I thought I had more ready and I don't. There we go. Should be sharing. This week we have the name exposure index at 8141. I know myself, I still am reporting around 100, 115, so I'm pushing that higher. So I don't know who's bringing my number down, but I'm doing what I can. Jay, I don't believe you're not a name member, so you don't contribute to this index. But are you familiar with it at all?
A little bit. I haven't seen it in a few years, so maybe you could bring me back up to speed.
No, sure. So the name membership is polled weekly every Wednesday to see what your current allocation is in your equities. Like
Hmm.
people who are taxable can they, and a lot of them can be 200 positive to 200 negative,
Gotcha.
and everything in between. Uh, and then I'm kind of in that range too. But some people will just do a balance, like they go to 60 to 80 to 60 to 80, kind of depending on their things. There's a wide range of management styles, although a lot of it is momentum based.
Hmm.
And then we just report a number what the typical number is or average across the membership every week, and it comes out on Fridays. Actually, Thursday late. I'll have to ask Heather about that. It might be Friday. Anyway, so yeah, worth noting. But when it is above 80, it tends to be a pretty strong market, even though we've come down a bit. So we should
Hmm.
be okay still. So I'm going to stop sharing, and we're going to dive into Jay. Thanks for being here. Let's dive a little bit into your background. Tell me a little bit about how you got to where you are now in your faith-based investment journey, and we'll go from there.
Yeah, so I started in the industry as a result of my family. I watched one of the hardest working guys I know. My grandfather grew up in New England in the Boston area, and he worked three jobs. And my grandmother, to the day she died, never had a license. He had seven kids. He worked three jobs and
Hmm.
literally limped into retirement. He got to retirement in the 80s, and he was living off of his pension. Social Security and CDs. And life was good in the 80s. He was making
Yeah.
15, 18%, making more than he was working, and thought retirement was all that he had dreamed about and then some. And he came from the Great Depression, never put any money into stocks. It was all safe money, CDs, and eventually inflation, taxes, and the nursing home, he developed dementia. And I saw him get wiped out financially. And as a young teenager, I said, this isn't right. This guy worked so hard. He deserves a lot better than what he got. And I started doing some research. What could I have done to help my grandfather? And that led me to the financial services industry and really started working in that industry, learning what I could. I started at Fidelity, worked at Merrill Lynch, and
Right.
worked in the banks, kind of made the rounds in the financial realm. And I was working in a credit union, and I had a client who knew my faith. She knew I was a Christian, she was a Christian, and she had been listening to Focus on the Family. And they were talking about faith-based investing, and she said, "Jay, can I really expect God to bless what we're doing here if we're investing in things that oppose his word?" And I was kind of like, well, "What are you talking about?" And she said, "Well, there's this thing called faith-based investing." And I was like, "Do you mean socially responsible investing?" She said, "No, it's your faith." And
Yeah.
I started doing some research, and I found that there were very few choices at the time. There was a company called Timothy Plan
Yep.
that did biblically responsible investing. And back when I looked at it in the early 90s and mid 90s, it was just kind of, I love the concept, but the results weren't there. And I'd been managing some stock portfolios, and I said, okay, here's what I'll do. I will take Timothy Plans holdings. I went and got a Morningstar subscription, got all of the detailed holdings of all their funds, dumped them into a spreadsheet, and I just started going away. Okay, I'll use my investment process and I will just apply it to these stocks that Timothy Plan are considering clean.
Hmm.
And I found through '08 and '09, when the markets were collapsing, that my portfolios actually did better than ones that weren't being screened. So I had two sets, the ones that were being screened and the ones that weren't.
Right.
And I found that my screen portfolios were actually doing better. And I said, there's something to this.
Mhm.
So that really convinced me to go full force into the biblically based or faith-based screening. And I started developing clients in that arena. And, that's really what got me into where I am today.
Wow, that's a great background. And you guys are I think you said you were diving into doing your own ETF soon, although your firm does have a couple right now.
Yeah, so we manage one in-house. It's called the Christian Stock Fund. The ticker symbol is PRAY on the New York Stock Exchange. And we distribute a couple of other funds for a couple of other Christian organizations. And
Mhm.
we'll be launching a couple of new funds later this year, a bond fund, as well as I'll be launching a fund based on the strategies we'll talk about today.
Nice. Yeah, yeah. I think that that's a great segue into your investment philosophy. I mean,
Sure,
certainly it's
sure.
faith-based as
It
you
is.
said, but beyond that, what do you look at? What kind of criteria is important to you when you're looking at stock selection?
Yeah, so the first thing that we start with is ethical screening. So for our clients, they really care about where they're investing. And it's not just about getting a return, it's feeling good about where they're investing. And there's no perfect process. So we try to do this as clean as we can. We ask clients, what do they want to avoid in their investments? Things like abortion, pornography, embryonic stem cell research, and some of the vices, tobacco, alcohol, gambling, and there may be a few others like Christian rights violations if you're dealing with countries like China that are persecuting Christians or terrorist regimes, things of that nature. So we will screen out companies and create what we call a clean universe. So we'll have, anywhere from 3 to 5,000 stocks that make it through our screens. And then what I will do is I will narrow that down to the top 10% of the universe. And I do that through a screening process that I've called FEVER over the years. It's an acronym, stands for financial health. Earnings is the E, the
Mhm.
V is valuation, the
Okay.
first R is risk, and the second R is relative strength. So it's a five-part
Okay.
screening process. I used to do all of this in Excel. That's where I started, and then I
Right.
found Y charts
Okay.
about 5 or 6 years ago, and they were able to help me build my screen so I can screen
Mhm.
daily rather than once a week dumping data into a
Oh,
Excel
sure.
spreadsheet. And what I'm able to do is stack rank my universe from
Mhm.
number one to number 5,000, how many stocks I have in there. And I'm focusing on the top 20% of that universe typically. And
Okay.
that would be, usually 3 to 500 names in most cases is what I'm looking at. And what I'll do is I'll rank those by the fever scores. And
Okay.
typically those top stocks, I'll then look at the strongest trends. I use a program called trend rating. And
Mhm.
trend rating helps me to see the stocks in my universe. It's kind of like a grade school. A's and B's are good, C's and D's are bad. So I'm looking for strong trends within my universe, and I'm letting the software really just dictate, what sectors I should overweight, underweight, and then I'll dive in and really fine tune. And the universe I'm constantly adding stocks to,
Mhm.
taking some away. So it really is a full process, but a lot of it is based on momentum. What
Okay.
is rising, and
Right.
it's kind of like I like to let the winners keep winning, and the losers, I want to find something that's rising faster than the market. So
Right.
it works a lot of times, typically when you've got a momentum-based market. Where it doesn't work is when you've got the whiplash, where the
Right.
market doesn't know what it wants to do. It's playing tug of war between value stocks, growth stocks, and you're just seeing a lot of bouncing around. But typically, I've been using the process now for 15 plus years,
Oh, wow.
and I've been able to beat the S&P over that period and any index I'm going against using the process
Sure.
that I've used. So I'm very confident that long term it is a very superior process.
Nice, nice. And I got a shout out to Trend Rating, who is a sponsor of NAIM. I'm very
Oh,
familiar.
nice. Yeah, I
They do
love
great
trend
work. They
rating.
really do. It's a
They
good
do.
program. Um,
Absolutely.
in your process, if you're doing relative strength, are you doing it against the benchmark that you're playing against, or is it really more about the strategy that you're comparing to?
Yeah, it's more the strategy that I'm comparing it to. So in my
Okay.
universe, I'm looking for the strongest stocks in there, and I use some criteria within trend ratings to look for some
Sure.
pullbacks and
Right.
to try to prevent getting a stock at the very top and just,
Of
seeing
course.
it kind of fade back. So I do have some parameters that I use in trend ratings, but it typically is going to be, what's rising in my universe and what's rising faster than typically the S&P is what I'm using.
Sure. And is their strategy always invested, or do you ever have a reason to where you might take a little sleeve of it out and be in money market or cash in a very bad situation?
Yeah, so I use a tactical approach. I
Okay.
use offense, defense, and on offense, I'm typically looking at the S&P as my major indice that I'm looking at,
Sure.
and I'm looking at the 50 and 200-day moving average. And typically, if the market is below both the 50 and the 200-day moving average, I'm on defense. If it's above the
Sure.
250, I'm on offense, and if it's kind of in between the 50 and the 200-day, I'm kind of in that middle neutral zone.
Mhm.
But typically, I obviously like to see the 50-day above the 200-day, and then
Of
I like
course.
to see, for offense, that's, your golden cross, not your death cross. So
Exactly. I
that's
was going to
typically what
reference
I'm
those, and
looking
I
for.
think I think
Yeah.
it's about. Aren't we really close to getting a golden cross again? If we
We are,
didn't,
yeah. We had the death cross earlier, and it
right,
looked like things were getting grim, but then we had a sharp rise, which is bringing the 50-day back above the 200.
right. Do you know if it has crossed, or we're just really close
I
to?
haven't looked, yeah, I haven't looked
I didn't.
today, but
I
it was
didn't
getting
see it.
close. Yeah.
Yeah. I thought it was. I thought it might be today if it's not going to be early next week. Yeah, those are longer term signals, and that's very a valid system. So, how do you anything else in the investment process that you think is worth noting?
No, I think the other thing too that helps is, because we're using trend ratings in conjunction with the strong fever store. So you're getting quality stocks and most of it
Sure.
because what you find is the earnings, the valuation, the financial health, those things will take out a lot of the junk that's in the market. There's a lot of, low quality stocks. They may be rising and have the momentum aspect, but they're not going to have strong fever scores for me
Right.
because they don't have the financial health as well. And sometimes I'll miss some opportunities, like if a sector like energy doesn't have the earnings coming around quick enough, I can miss some of those opportunities. But trend rating helps me to make sure I don't miss those. I used to just use Y charts and the fever scores, and I was
Sure.
missing, energy stocks would run for 6 months, and finally the financials are catching up. And I'm like, okay, now I'm getting into energy. I should have done this 6 months ago, but the pairing of my fever score with trend ratings really has helped me to find some of those trend movements a lot faster within sectors.
No, this totally makes sense. And of course, since the E is earnings, you do want to see earnings in
I
your
do. I
your
do.
list, not which is funny because there are times where the non-earning companies will do great. And there's a lot of garbage companies like the
Yeah.
Russell 2000 that are worth not worth anything, but they go up for whatever reason.
Exactly.
So I get that, but it's also a safer, more reasonable play, more reasonable way to invest to make sure the companies are making money versus not. So
Exactly.
I
Yeah.
absolutely understand that. Nice. I know you had some slides to look at. Is that something you want to jump into now, or you want to
Yeah.
push into how you pairing with financial planning?
Yeah. Let me kind of share my screen just so you
Okay.
can kind of see
Okay, your
big
process.
picture.
Awesome. Yeah, do that.
Yeah. Yeah. So you can see that okay?
Went away.
Did it go away?
Yeah.
Try it again.
Mhm. There we go. Coming up. And we have there we go. Nope, it went away again.
So whenever I try to do a slideshow, it leaves.
Oh, strange. All right. Well,
Let me just try one more time here.
all right.
Can you see it?
There you go.
All
Yep.
right.
Perfect.
So our
Portfolio
firm st
process.
yeah, so our firm starts with, kind of big picture, what the client's trying to achieve. We lead with holistic financial planning, and we do it all from a biblically based, what's important to the client, what are their values, what are they looking for in a portfolio manager, and then we will apply the ethical filter. Sometimes it's exactly what we screen for.
Mhm.
Sometimes we'll have clients, they've got, I don't want any pharmaceutical companies, or they've
Right.
got some kind of custom requests. We try not to encourage that because we don't want to have, 50 different portfolios, but we
Yeah.
do look at what's important to the client. We do our fundamental research, construct the portfolio, and then we use risk management. That's the tactical active management. Typically each month, we're using a combination of ETFs along with individual stocks. And the ETFs, for the most part, are kind of core positions. We'll use our Prey ETF, the Christian Stock Fund, as a core position. We'll add in some gold and silver, some Bitcoin. some bonds to have the asset allocation, and then really where the tactical movements are happening are in the individual stocks. And that's what I've been
Sure.
kind of running for our clients at the firm. And later this year, we'll have an ETF, so it'll make it more tax efficient for our clients and for our smaller clients that don't have exposure to the individual stocks. We'll have the ETF that'll help uh,
Yep.
kind of bridge the gap because, for example, last year, my stock strategy was up about 75%.
Mhm.
The Prey ETF did good last year, but more in line with the equal weight S&P. So
Okay.
clients that were under 100,000, there was cases where there was an 8 to 10% performance difference because of the lack of the individual stocks or adding that
Yeah.
ETF component to
Yep.
help standardize the performance. But
Oh,
really,
makes
what we
sense.
look at is the screening process. We look at a client's portfolio to see what are they currently supporting from a stock, ETF, mutual fund perspective. And then we'll show them, here are some clean alternatives. You're going to get professional management, a systematic approach. We apply that ethical screening. We use a program called Evaluator, which will help us look at mutual funds, ETFs, and stocks. And I kind of put together, kind of a what are the ethical filters we're using so you can kind of see those protecting human life,
Sure.
entertainment, substances, indiscriminate arms, and then human rights and labor practice violations. And then what a typical screen would look like. Unfortunately, a lot of the MAGs 7, I call them the lag 7 this year. They're actually
Yep.
lagging. So,
Right.
most of these, unfortunately, for people that want, exposure to them, NVIDIA and Tesla are the only two that pass our ethical screens.
Really?
But most of the top 7, just because, they're in everything. And if a client doesn't want to be in that,
Of course.
it's going to fail the screen. So we'll start there. And then for the Y charts, we'll do our financial health, earnings trend, valuation, risk, and relative strength. And this is an old screen, but you can kind of just see, where it's
Sure.
ranking all the way from 1, and then this will go all the way to number 4,000 for us. And then what we'll do is
Mhm.
take our top 10 or 20%, look at trend ratings, look at,
Yep.
where the green spots are. We throw it into the software, and then it'll kind of help us identify, how much should we weight each position. We'll do a deep dive into the position. Do we believe with the
Yeah.
thesis, where the stock is going? Does it look, are we missing anything here? And then, we'll make some customized tweaks to the process. So it's not just all computerized. There's a human element. The
Right.
stocks that are in the universe, there's some that we're adding, subtracting to. So it is, an ongoing process where each month we'll probably have maybe 2 to 3 stock sells, replace them with 2 to 3. Some months it may be 7 or 8 stocks we're selling and buying. Another month it may be 1, maybe 2, but there's usually at least a few changes each month. Stocks we're rotating out of that have kind
Right.
of lost their trend, gone from an A or a B to a C or a D, and we're seeing a better opportunity for an A or a B stock.
No, absolutely.
And
Absolutely.
then we also
And
use trade stops for, kind
oh
of
yeah,
individual risk management, looking at it from a individual stock
I haven't
component.
seen
But
trade
that's,
stops.
yeah, they're at least they were at least affiliated with Stansberry Research at one point. I'm not sure if
Gotcha.
they still are. I think they're in that group there.
Okay.
But trade stops is something I've used for, probably 10 years now.
Nice. Nice. So what does trade stops do? Might as well, since we're on it.
Yeah, so it basically gives you 3 zones. Green zone is an uptrending stock. Yellow
Okay.
is kind of sidelined. It's flatlining. There's warning here, and then red is a stock that's bearish or heading in the wrong direction. So
Sure.
we're typically looking for green stocks, uptrending stocks, similar to trend ratings, but
Okay.
it gives you stop levels. You can see here, it'll be in the yellow zone if this
Gotcha.
was from last year, but if it Costco was at 842. If it pulled back to 755, it'd be in the yellow zone, and then it gives you kind of an exit point. So you can see based on the historical pricing of Costco since it started publicly trading, what is a normal pullback versus what is something
Right.
that's abnormal. And then we're going to look at, is it company related? Is it industry related? Is it market related? If it's company related, that's the one we're most concerned about. The
Okay.
industry, well, maybe we want to underweight that industry, but if it's company related, why? Are people not shopping there? Did they lose a big major contract? What caused them to lose that trend? And that's really where it becomes a sell if it's company related and there's no hope for a turnaround or rebound on it.
Right, right. And I like how you said you still have the human element, even though you have all this screening and whatnot. I've found so many people, so many advisors. It's really the edge is the human element.
It
You
is
can
for
run
sure.
tons of screens and it can give you the answers, but if you're purely running, you just somehow it just doesn't seem to work out as well as it should. Even if it tests amazing, it's when you add that human element, that's really where the magic happens. Uh, so it's neat to see you implementing that sort of thinking.
Yeah,
Because technical and data can only take you so far. Then you have to actually make a
exactly.
decision, which is a little bit
Exactly.
be outside of what the data can do, at least so far. We'll see where AI takes us, but
Yeah, we'll see. And
absolutely.
there's some examples too where, there'll be someone's trying to hit a short position and they're putting out negative press on a company and you look through the report and even though, one of these may say it's in the red zone or it's gone from an A to a D, but you're looking at it saying, this is just a firm trying to make money off a short position and this is going to fade. There's no substance to the report, and we'll hang on to a stock sometimes because we know it's not good data. It's just someone trying to take a short term hit on a stock, and then
Right.
once their earnings come out or some news comes out, the stock rebounds, and
Mhm.
we'll look at probably cutting it at that point just because of the volatility or whatever. But again, that's where the human element's important, and we're not just using hard stops on something if it doesn't make sense to get out of it.
No, fantastic. Made me think of Nike today that shot up on earnings quite a bit. I don't know if you saw that.
Hmm. Hmm.
Wild, but yeah, that'd been beaten up, but for good reason also. So that's a that's a different story
Yeah,
for
it
another
is.
day.
But I would say too, this is, more the investment process. So when we're
Mhm.
looking at, more the financial planning aspect, again, we
Yeah.
use holistic planning. So as fiduciaries, we're looking
Yeah.
at everything from their estate plan to their investment plan, tax management. We're looking
Mhm.
at insurance. So we're getting a big picture look at their finances. And obviously the investments are a quarter of what we do. It's a
Okay.
good part of our focus, but there are other things where we've got families that are trying to leave money to kids and
Mhm.
churches and ministries. So we're
Right.
helping them to save money on taxes, to get ahead of inflation, make sure they don't run out of money in retirement.
Right.
And then also, we want to make sure that if they needed long-term care down the road, we've got a plan in place, not always
Right.
insurance, but we've got a plan. And that's really where that comprehensive planning is where we start. And then obviously, as we get into the investment aspect, there's a lot to that. But it really starts with we use Retirement Analyzer and eMoney as our two tools that we
Okay.
use for financial planning at our firm.
Sure.
Retirement Analyzer is kind of a smaller uh, niche kind of program, but it really focuses on retirement. There's a lot of other angles to it, but
Sure.
that is one of the softwares that we use for a lot of our clients.
Do you guys happen to use Holistiplan for the tax side?
We're looking at that. We have not added that
It's
yet,
a
but
very cool program. I know
yeah.
there's NAIM has a financial planning mastermind the second
Hmm.
Tuesday or second
Hmm.
Thursday of every month. That's you should definitely hop on if you're a planner. I know
Absolutely.
that a lot of people share tech and what they're using and what's working and what's not. And Holistiplan comes up a lot as a favorite software.
Yeah, we're in the evaluation process for
Yeah.
that, but it's really neat where you can just upload your tax return
Oh
and
yeah.
it spits out a ton of,
It's
planning
it's really
opportunities.
useful. I know we use that here at our firm, so it's definitely
Yeah.
I'm a fan of it. So anything else you do from a pairing of your active management style to financial planning? Do you find that helps with your incomes, hitting your targets and making retirement last and things like
It
that?
does, yeah. So a lot of people don't like annuities, but we typically will use three sources of income for most of
Okay.
our clients. We'll look at Social Security, and then these days, very few people have pensions. And
Hmm.
so what we'll do is we'll carve out, instead of putting it into bonds, we may carve out, 20% of their portfolio going to a fixed indexed annuity where we can
Okay.
say, it's got a 7 or 8% guaranteed income. So we can create guaranteed income for life for a part of the portfolio so that we don't have to take as much risk on the managed money side. So we'll have
Hmm.
those three parts: Social Security, private pension using the indexed annuity, and
Okay.
then we'll use the managed account for the growth and inflation protection.
Interesting, interesting, and I've seen that be used as the bond side, which makes a lot of sense because the whole point of the bond side is really a diversifier or to help you reduce risk. And a lot of the time, the bond market last 3 years has not done
Yeah,
that.
it's been highly correlated to the
It's
stock market. You look at,
excuse me.
COVID, you look at,
Yeah,
when rates were going up, bonds were going down and the stock market was going down. So you didn't have that separation. So I like
yep.
the indexed annuity because it's providing stable income and you don't have to worry as much about the ups and downs of the market.
Certainly from a volatility management standpoint too. It's
Hmm.
not you're not getting the swings, and hopefully that helps them stick to their plan because that's the hardest part. When
It
things
is.
go crazy, is can you stick to your plan? And if the plan
Exactly.
works, and you can demonstrate that, it makes life a whole lot easier.
It does. It does. And you get people to fill out these risk questionnaires. If
Mm,
the stock market drops 20%, oh, I'll stay in. And the second it starts dropping, they're like, get
yep.
me out. It's like,
Right.
yeah, I want to go on the big roller coaster. And once you're on it, you're like, get me off this thing. I don't want to go on it again.
Every time,
Every time.
and I think the clients sometimes have an amazing ability to say get me out at the very bottom.
They do.
Um,
Yeah.
yeah. So wild stuff. So anything else from a planning standpoint that you do that implements the active management?
No, I think a lot of what we do too is, the fact that we're trying to save our clients money on taxes. So we've been
Mhm.
using a lot of efficient strategies with the qualified distributions to charities and
Yep.
IRAs and setting up donor advised funds and
Yep.
just doing a lot of management on that side so that we can help them have more so they can give more away. So that's really, again, the
Yep.
foundation of our planning is really looking at that active management, trying to outpace the market with less risk
Mhm.
and also in companies that they can believe in. So when a client opens their statement, they see stocks that have passed our screens, they
Mhm.
recognize some of the names and they've seen the performance and really puts clients at ease knowing that we've got a solid process in place and lines up with their values and we're looking at not only just the investment side but the big picture. So it all kind of ties together.
Love that. That makes a lot of sense, and especially if you're doing charitable planning, like you said, QCDs and things like
Hmm.
that. I mean,
Hmm.
having more of like an endowment approach to the investment makes a lot of sense because you want this to be a long term, um, you know, way to generate money, both for in retirement and for charitable purposes. So,
Yeah. And that's a great analogy because we almost run our money, more like a hedge fund than we would,
mhm.
a traditional Edward Jones or
Right.
Ameriprise or one of the big firms, not to knock on them, but, we have, managed futures, we have commodities, we have
Yeah.
gold and silver, Bitcoin, in our asset allocation. And that's really, different from a lot of the, bigger firms that are just, put it all in funds and put it all in, international, large
Uh-huh.
cap, mid cap. And,
Yeah.
that's great when the markets are rising, but you need, when the dollar's down 9% this year, you need some gold and silver and Bitcoin to
Yep.
diversify away from that risk.
No, absolutely. We see that a lot in those same people that you named is, they have this, they've got the large cap, the small cap, and this small cap's been trashed for how long?
Yeah,
It's
exactly.
no, it's not benefiting them to have this
No.
diversifier. Same with bonds. I mean,
Yep.
there are better way to play that. There are
Yep.
better ways to play that. So I find that's, yeah. I think having an approach where at least you're aware of all the situation and go, hey, this is not a good part to be in. Let's go with stuff that is. And relative strength screening is really a great way to come at that. So,
Yeah, it is.
uh,
And I love Harry Brown, the permanent portfolio strategy too,
yeah,
where you've got a lot of things that are hedging against different economic conditions. So,
yeah.
we kind of try to use some of that in our asset
Interesting.
allocation and, rather than all gold and silver in the gold bucket, we have
Right.
Bitcoin in there as well and some commodities too.
Right. Well, awesome. Well, great conversation today. I know we have the NAAIM Outlook conference coming up in November 3rd and 4th. Maybe we can convince you to be out there in
Yeah,
Chicago, but
yeah, I'd love to.
we'll try to get you out there.
Yeah.
Any last, do you have a favorite investment quote before we wrap this up?
I do, yeah. I mean, I know it's probably overused, but for a lot of my clients, this is really what it comes down to is rule number one, don't lose money. Rule number two, don't forget rule number one. Warren
Right.
Buffett, I know it's overused, but my clients, it's really important to them to not run out of money, not lose money.
Right.
So, that's really a quote that's always stuck with me and clients love it. When
Yep.
you bring that to them, if they haven't heard it before, they get a little chuckle out of it.
Yeah, absolutely. Absolutely. That's a great way to think. And that really ties into what you're doing with the
It
endowment
is.
style of making money
Yep,
last. You have to think
exactly.
differently than the
You
traditional
do.
allocations. It doesn't
Yeah.
work the same way.
Because a lot of people are like, we were down 15%, the market was down 20, we won. My clients are like, no, you still lost 15%. That's not a good
Exactly.
year.
That's the conversation every
Yeah,
time. I completely
yep, it
agree.
is.
Jay, great to have you on. Great to meet you. Hope to see you in Chicago. And
Yeah,
I guess we'll see
absolutely.
everybody next time. Thanks
Sounds
a lot,
great.
Jay.
Thanks for having me on.
All right, see ya.